Good afternoon, and welcome to First Horizon's Economic Unknown, What's Around the Next COVID-19 Corner virtual event. This event is being recorded for future listening. All lines have been placed on mute. I will now turn this event over to First Horizon's Chairman, President, and CEO, Brian Jordan.
Good afternoon, everyone. Thank you for joining us this afternoon. I appreciate you taking time out of your busy schedules to visit with us. We're going to spend the next little bit talking about the current economy. This is the first in what I hope will be many of these virtual events to re-enter the build-up or the recovery of the economy. As much as we've experienced in the last few months, the one thing that we've all gotten used to is using technology to improve lives and communication. And I would dare say many people have gotten accustomed to working from home with the use of technology. So hopefully we'll have many more of these events that you'll have an opportunity to join us. Just a couple of minutes on my view of the economy, and Jerry and Tracy will give you a much more thorough view. We are at a fairly significant inflection point. It is a time when the recovery is starting to show. There are signs of what can be defined as green shoots. You're seeing a pickup in credit card transactions, gas pump traffic and travel is picking up. Some anecdotal signs of hotel occupancy rates going up, but you also have a strong sense that it's going to take a while for us to fully recover. This is a medically driven event, and it's going to take a medical solution before we get back to what we would easily phrase as life normal. It's going to take a while, in my view, to see the buildup of the economy and the recovery, but I'm optimistic in that regard. I have a very good friend, John Hope Bryant, who often says a moment does not feel historical when you're living it. It's only historical in a reverse looking sense. This is clearly a historical time. The economic data that we're seeing in this environment is bad or worse than any has ever been seen in any living person's lifetime. It's amazing how fast the economy has moved down. I'm really pleased with how our organization is positioned. We have a strong capital base. We have the ability to step out and to help our customers and our communities. A couple of points on that on the next couple of slides. First, on Small Business Administration lending. We have been very active in the Paycheck Protection Program that the SBA and the Treasury stood up. It's been a program that I think has been successful. Not to say that it didn't have its fits and starts as a result of just the sheer mammoth exercise or extent of what had to be built, the infrastructure that had to be built at the SBA, what the financial services industry had to do to support customers and communities. I'm very excited to point out that both Iberia Bank and First Horizon originated over $2 billion of loans each under the PPP program, and there's still money available. So to the extent that others are looking for paycheck protection money, the ability to keep employees connected to their jobs, to keep small businesses open, it's a good program, and there's still money available in the program, and both organizations are there, ready and willing to help. On the next slide, you'll see a little bit about some financial contributions that the First Horizon Foundation. We are strong believers, both at First Horizon and Iberia Bank, that the strength of our communities are what makes us successful as an institution. So we work really hard to not only give back of our time and our employee commitment to the community, but to dedicate financial resources to help our communities, to make sure that we're strengthening the entire economic fabric. In this case, we made $2.5 million worth of donations to support the COVID relief efforts, both in helping people tide over in this period of uncertainty, food programs, things that essentially will strengthen communities in the near term and hopefully accelerate the recovery. So with that, I appreciate you joining us again. Let me turn it over to Jerry Lorraine, Chief Investment Officer of First Horizon Advisors, and Tracy Bell, Executive Vice President and Director of Equity Strategies for Iberia Wealth Advisors. Jerry?
Thanks, Brian. Appreciate it. Thanks, everybody, for your time today. We do appreciate you being here. On New Year's Eve day, Chinese officials confirmed multiple pneumonia cases stemming from an unknown cause. On February 11th, the World Health Organization named the disease caused by the novel coronavirus, COVID-19. By April 10th, every state in the union had been declared a disaster area, and the number of COVID-19 cases exceeded 500,000. Now, at the end of April, the social distancing guidelines created by the White House Coronavirus Task Force expired, and select states began the process of reopening their local economies. Those social distancing guidelines and the stay-at-home strategy for containing the spread of the virus has had a devastating impact on the economy. It hit the financial markets like a tsunami. Tracy, can you describe what you've seen happen to the economy and its impact on the capital markets?
Sure, Jerry. Thank you all for joining us. Like Jerry and Brian said, we really look forward to this, and thank you for your time. So the first thing that happened here within financial markets was an incredible spike in volatility. So we've showing you here on the left side of this slide the VIX index that measures volatility that you can think of as risk or fear within the financial markets. And you can see that sudden spike there at the middle, roughly to the end of February. This is when the market started to sniff out, man, we've got a problem. And we started to understand how quickly this could actually impact our financial markets. So it's improved. That spike up to 70 was quite extreme, but it has improved here and come back down into the low 30s recently. We're still not back to that nice between 10 and 20 level that we were at for such a long time prior to this. So this is one of the things that we'll watch to see how the market is behaving. On the right here, a secondary impact that came along not too long after the volatility spiked, we had earnings expectations for S&P 500 companies fall dramatically. This has been about a 19.5% decline in earnings expectations over the next 12 months. Before COVID hit, we were somewhere around $178 per share for the next 12 months. Now we're down around 143, 142. Hopefully we hold in there. But that is a 19.5% drop in earnings expectations is a lot, and companies are really unsure as to what the next 12 months looks like for them. So some of the hardest hit areas, not a surprise to anybody, restaurants and hotels, travel and airlines, anything related to leisure or hospitality, non-essential retail like clothing stores, even banks and insurance companies. Everybody's concerned about the ongoing business economy. Some healthcare providers, which you would think would be defensive in this environment, and of course many are, but some that have had a problem because the higher margin elective procedures are canceled or other surgeries are delayed as they tried to free up resources within the healthcare system to potentially deal with a surge in viruses and very ill people. We don't have a slide on this, but the energy market turmoil has been substantial. We had considerable oversupply that was taking place in the market before this hit, and then COVID hit, and we had a sudden demand shock on top of an energy oversupply. So we actually had WTI oil trade negative during April. So something in the energy market that was historic as well. We'll use that term a lot. So we've seen particularly stress in small to medium-sized businesses. This is important because these are 49% of private sector employment. And we all think about the large companies that have the large payrolls, but it's really the small to medium-sized businesses that drive a lot of the entrepreneurship in America. So with consumption being 70% of GDP, that's consumer consumption, half of our private sector employment being impacted by this is a real problem. On the left here, we're showing you a slide that has the weekly initial unemployment claims starting back on March 13th. So we show you March 13th because that was our run rate. 282,000 new initial unemployment claims each week is about where we were bouncing along, 200 to 300,000. It's been that way for quite some time. When our COVID-19 mitigation efforts began and we started to see an economic impact. You saw that immediately on that March 20th initial claims data. Over 3 million, then over 6 million. It's come down now, but it's still over 3 million per week that we're getting claims on. That's a big number. You translate this to the unemployment rate, which we got last Friday, and unemployment has now jumped to 14.7%. Again, historic. That is a very large number. So the high levels of economic uncertainty is what you have as a result of this. Falling business and consumer confidence. We show you two slides on this here. On the left, the Federal Reserve has general economic and health policy indexes that they measure. They have a lot of uncertainty indexes. These are the two that are particularly useful right now. These have spiked up. No surprise that everybody is concerned. And then over here on the right, we're tracking both consumer and small business confidence. That blue line is consumer confidence. And that red line, that is the NFIB, National Federation of Independent Businesses. So that is Small Business Optimism Index. That's fallen as well. These are two things that we'll continue to watch because these need to improve if we want to see the economy improve and people get back out there again. Any silver linings on these? So any winners or losers in this environment? Or I should say any winners. There are certainly plenty of losers. You know, we've had some winners in places that, again, are not surprising. Internet infrastructure. Here we are all on a WebEx right now. This is something that companies are doing more and more. And the publicly traded companies that supply the backbone of the internet and the telecommunication structure for these types of calls are winning. Streaming services, we're all at home. We're all watching more television. Consumer staples, have you tried to buy toilet paper lately? Not a problem there for consumer staples companies. They've continued to do well. Drug companies that are involved in antiviral development and research, vaccine research, and then of course testing labs. Those are examples of some companies that have done well in this environment.
Tracy, what you've just described pretty much guarantees that we're in the midst of a recession of an unknown duration. But it could have been a lot worse, right? I mean, the rapidity and enormous magnitude of the monetary and fiscal policy responses may have avoided a 30s-style depression. Can you talk about what the Fed and Congress put together to cushion the economy and protect the markets?
Yeah, so we have a financial system and a set of folks running the financial system and government that have learned over time from past experiences. You know, a lot of research was done after the Great Depression, and then we learned a lot as well during 2008 and 2009. So the first thing you saw happen here was the Federal Reserve jump in with a response. The Fed is the entity that can act the quickest in this environment, and that is what they did. So we've got two charts here showing you on the left the size of the Federal Reserve's balance sheet. You can see that jump there. We've notated the COVID-19 response. And then on the right, this was the corresponding drop in Fed funds interest rate, so the overnight lending rate between banks. This has dropped now to a range of 0 to 0.25%. Lowest it can go. The Fed talks about negative interest rates and it doesn't want to go there, and we don't blame them. So we're at 0 to 25 right now. So this was the Fed's big response here. The goal was really to restore market liquidity. When risk jumps up, when volatility jumps up, suddenly people that want to be risk-averse buyers go away. And there's not as many buyers in the market, not as much capital that can come in and satisfy the buy side of the seller-buyer market. So the Fed says, we'll jump in here and we'll be sure there is enough liquidity. So the goal here was that the liquidity function within the market did not turn into a credit event. The Fed was basically saying to the market, look, if you're a going concern, you're a good credit. We don't want the fact that things are a little gummed up with the plumbing here to tip you over the edge. So that was the purpose here. U.S. Treasury programs, those were put in place really to support the business side of the economy. The PPP program that Brian talked about earlier, the Main Street Lending program that is also out there. These were put in place to help preserve businesses, small to medium-sized businesses, hospitals, payments directly to individuals to support workers, state and local governments, anything that was being impacted by this sudden demand shock, this sudden stop in the economy. That's what the Treasury was getting at here, was trying to put the safety net underneath that side of the economy, whereas the Fed, these list of programs here on the left of this box, was trying to get at market functioning and liquidity. Down towards the bottom of this list of Fed things, you've got the Fed administering some of these programs that have been put in place by the Treasury. The two work together to make these things work and disseminate these funds throughout the economy. Of note here, total costs projection over 10 years on these Treasury programs stands at 2.4 trillion right now. So that's sizable. And on our next slide, we've got a little bit more information about that. So right now, if you compare the stimulus size to 2019 GDP, in 2019, that's over 19 trillion. And now here we are that we've got 25% between monetary and fiscal stimulus, 25% of 2019 GDP has been pushed into the system. That's a big number. It's a huge number. When you apply some of the leverage ratios that the Fed can put in place, this is lending, and lending is leverage. So when you apply some of that, this number gets even higher. This is big support for the economy. And, the market has responded to this somewhat that we'll show you in a minute, but this is a big response. Now, this does have an impact here. So on the right side, we're showing you the change in the deficit as a percent of GDP. So prior to COVID-19, these are all Congressional Budget Office estimates, and we were going to have a deficit of about 4.6% of GDP from 2019. In 2020, the deficit was going to run about 4.9 and about 4.8 in 2021. So pretty stable, increasing a little bit, but pretty stable. After COVID-19 in 2020, when most of this support is going to take place and borrowing take place, you see an increase of 13% for a total deficit of 17.9% of 2019 GDP. That's a lot. And then again, in 2021, the deficit is still 9.8%. So, you have to deal with the problems in front of you, and that's what we're dealing with today. And we will have to deal with the spending side of this a little bit later on.
We know that a lot of people are working at home now. The question becomes how many of them are actually going to get back to the office and what impact that might have on things like commercial real estate occupancy. Looks like a mighty fine mess we're in right now. And I have to assume that this chapter in our history will end at some point, even though I don't have the faintest idea of when that might be. What will you be watching for to identify when we might be turning the corner, Tracy? What do you see longer term for how we will work and live? Will you be kicking off your red bottom shoes for good and living in flip-flops?
Well, Jerry, I wish I had some red bottom shoes. I don't have any of those. Maybe one day, right? So I think what is most important here is the protocols to contain the virus and both reopen the economy. We have to get things back moving again, but we also have to protect the health of the folks that we know and love. This is a big event for not only worldwide, but for people individually. Nobody wants to lose the people they love in this. So the continued work on drug treatments and vaccines is going to be of utmost importance because that eventually leads to confidence. That will dictate how quickly people venture out again, regardless of whether or not businesses are open or closed. If people don't feel safe, they aren't likely to go out in public and mingle like they have in the past. So we're showing you a couple of slides here that I think speak a little bit to how the markets are interpreting this so far. Over here on the left, we've got two things on the top pane. Let me explain what's going on here. The blue line is the actual price level of the S&P 500. So this is as of probably Thursday or Friday of last week when we finish these slides up. So roughly 2881, and you can see the rebound that's taken place here. That low was on March the 23rd. And we've had a little bit of a move back since we hit that low, and now the market is hanging on here, really in a little bit of a wait and see mode. That red line, that is the PE ratio of the S&P 500 based on those expected earnings over the next 12 months. That PE ratio is a pretty broad measure of valuation, and it's back up to a level higher than where it was pre-COVID-19. So as investors, we look at this and say, okay, the market has certainly regained some confidence, but now it's trading a little bit higher. And part of that is dependent upon the earnings down here on the bottom part of that page, which is the chart we showed you before, where they had come down considerably. Then on the right-hand side here, we see the yield on the U.S. Treasury bond. We've got that inverted or turned upside down so that you can get an idea of price. The fact that Treasury bonds are still trading at a high price or low yield tells you that the Treasury market hasn't completely bought into the rebound story yet. It's still remaining very skeptical on all of this. So the equity market's getting a little bit more in step with this. The Treasury market's still waiting a little bit. So what we will be watching, Brian mentioned some of these earlier, things like gasoline usage, hotel revenue per room, they call it hotel RevPAR. Other economic data like rail car volumes, retail sales numbers, data on the health of the credit markets and bank balance sheets, and then what the consumer is doing. How fast jobs come back, that's important. And then watching PMI surveys very closely. PMIs are producer manufacturing indexes, are purchasing manager indexes, and they tell you what the people they're closest to the business of the economy, buying and selling the things that businesses need, what they're thinking. And these surveys come out every month, and they tell you if the purchasing managers think things are getting better or worse. And on the next slide, how fast will employment and GDP recover? You know, this is the big question that we really don't know the answer to. This is the current actual versus expected. So these are consensus expectations of economists that all submit their work. So the blue line is what we have for actual results. So the first quarter advanced estimate number is in there. That's the first dip down in the blue line. And then those red dotted lines, those are the forecasts. So this is comparing to the prior point last year. So thinking the second quarter of this year will be down 8.5% versus the second quarter of 2019. The third quarter might be down 4.2% versus the prior year, and the fourth quarter 2.9%. So expecting to hit a trough here in the decline and start heading back up, but still by the end of 2020, we won't be quite where we were at the end of 2019. So keep that in mind. You know, as Brian mentioned before, this is going to be a long way out of this. This is not something that you just turn on a dime, and there's still a lot of unknown here. Longer term impacts, we're looking at things like supply chains, manufacturing and office space needs, telecommunications. What happens with the cash reserves for companies? Companies have historically operated on very, very tight cash margins. That's an efficient way to operate, an efficient way to create profitability for the business. Maybe they need a little bit more of a margin of safety in their cash now. You know, what happens with share buybacks? A lot of companies that did share buybacks ended up needing to be bailed out. So, you know, potentially investors want to see a little more margin of safety there. So that's something we'll be watching. There are going to be winners and losers here. And of course, our job as investors is to figure out which companies we believe will benefit longer term. And what we say to folks is be patient, be disciplined. We still have a lot of uncertainty over the next several months with this. Volatility probably isn't over. Surprises are more than likely not still in the cards. So just be cognizant of that fear and that greed. You know, if the market starts running up like it has over the past month or so, don't let that greed take over. If we have more volatility, we have more surprises, don't let that fear take over. Stick to your plan, stay where you need to be.
Thanks, Tracy. This next slide speaks a little bit to that volatility issue. And the point we're trying to make here is that volatility decreases over time. This is kind of the fancy way of showing it from a statistical perspective. On the next slide, you can see it from more of a real world perspective and something that's probably a lot easier to understand. But at this point in the pandemic crisis, I think it's time to reference your financial plan and benchmark your progress towards your goals. You likely aren't off track if you've done a good job understanding your short-term risk tolerance and your long-term return needs. Now, you need to keep your perspective, as Tracy said, because financial markets, especially equities, can be very volatile. But over longer periods of time, the odds are in your favor. And this slide from the behavior gap shows that if you have that longer term view, things look a whole lot smoother than if you're looking at what's happened over the last 5 days. So most of all, understand that your personal situation is unique. We cannot possibly address those specific needs in the context of a general presentation like this one. Well, it's time to wrap this up. Tracy, you've given us a lot to think about. Thank you very much. We've covered a timeline of the events surrounding the global coronavirus pandemic. We've described the economic impact of the government-mandated virtual shutdown of business and social activities. And Tracy has shared with us what she sees as a path forward and how this episode may change our lives in the years to come. Thank you very much for your time today. I'm going to now turn it back over to our Chairman, President, and CEO, Brian Jordan, for some closing remarks. Brian?
Thank you, Jerry. Thank you, Tracy. Again, thanks for joining us. It is a certainly an uncertain time. It is certainly historical as opposed to any other time in my lifetime or career in particular. There are more known unknowns in this environment than I've ever seen, and there's clearly a lot that we don't know that we don't know. As Tracy pointed out in her slides, the Federal Reserve has provided a tremendous amount of liquidity to the market and is prepared to continue to do that, beginning a new program today to buy corporate bond ETFs. The Congress has provided or appropriated a tremendous amount of stimulus, call it somewhere between 10 and 15% of annual GDP. And they're continuing to talk about whether they continue to appropriate more funds. It is, as I said earlier, a healthcare driven opportunity or dislocation. It's going to take a while for us to figure out how we function in a safe and socially distant world, keeping the virus at bay and at the same time get the economy back up and running. And it will be uncertain, I think, for a number of months. I am optimistic that we will see a medically driven solution to this. I have a tremendous amount of confidence in the healthcare capabilities, not only here in the U.S., but on a global basis to meet these challenges. Until then, First Horizon is prepared to help you meet your financial goals, whether it's lending or deposit activities or financial advisory, estate planning, whatever it happens to be. We're there, we're open for business, and we're prepared to help you through this difficult and challenging time. Be on the lookout for future events, and hopefully you'll be able to join us as we have future discussions. And with that, there is a survey that we'll ask you to complete at the end. If you would, it would help us fine tune these presentations to be beneficial to you. If you would complete that, that would be helpful. So thank you again for joining us.
Thank you, Brian. As a reminder, this event has been recorded and a link to the recording will be emailed to you within a few days. Be on the lookout for future virtual events, which will be posted on the same site as today's recording. If you have questions from today's presentation or would like to talk further with either Jerry or Tracy, please reach out to your banker who can answer your questions and set up a meeting with today's speakers. Finally, as mentioned, please take a few minutes to answer a brief two-question survey as you leave the event. Thank you for attending, and this concludes our event today.